You can't have a bank like First Republic go under and then days later tell everybody that the system is solid and sound, because you sound ridiculous when you say that, okay? Here's what it says to investors. It makes them nervous. Do you know why it makes them nervous? Because if you're not concerned, you damn well should be.
David Rosenberg, what does the outspoken, data-rich, and frequently contrarian economist have to say about the economy and markets now?
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Everybody's asking, where is the recession? It's been over a year since the Federal Reserve started raising interest rates. And as you can see from this chart, this has been the most aggressive Fed tightening cycle over the past 40 years. The rapid full 5 percentage point rise in interest rates has sprinted ahead of all of the others. There have been 14 Fed hiking cycles in the post-war period, and 11 of them landed in recession. The other 3, ending in 1966, 1984, and 1995, were so-called soft landings, slowdowns but not contractions. Well, Fed tightening cycles are always followed by some sort of crisis. Is the failure of Silicon Valley Bank and takeover of First Republic the end of this cycle's crisis? Well, for answers, we are delighted to welcome back for our annual deep dive interview the influential, thought-provoking, and tell-it-like-it-is economist David Rosenberg, who kindly provided us with those charts and information. Dave Rosenberg is president, chief economist, and strategist at his independent economic consulting firm, Rosenberg Research, which he founded in January of 2020. For the decade before that, he was chief economist and strategist at Canadian asset management firm Gluskin Sheff. And prior to that, he was chief North American economist at Merrill Lynch, where he was consistently ranked an all-star analyst by institutional investors. His daily Breakfast with Dave newsletter has long been considered a must-read by retail and institutional investors alike. Now, in mid-2022 on Wealth Track, Rosenberg said we were in a recessionary bear market, that inflation would moderate with or without Fed tightening, and the S&P 500 would eventually bottom at 3,100, considerably lower than it was then and is now. So I started by asking him what happened to the recession.
The recession is a transition period. When I was last on the call, we were making that transition from late stage expansion towards the recession. And what I was saying at the time, with the stock market having peaked in late 2021, early 2022, and the duration of the bear market, the magnitude of the decline heading into the lows, and looking at the cyclical stocks getting hammered the most, were telling us that the stock market, by the way, along with the inverted yield curve, very consistent signals that a recession was coming. So very tough to pinpoint the actual day, week, month, quarter. And I think the recession is actually in the process of starting either this quarter or next quarter. So we're much closer to it than we were before.
There were two, quarters of contraction in 2022 that, most of us who have been around long enough said, well, that's the definition of a recession. But it didn't happen, right? Fed Chairman Jay Powell said, this time really is different. And that despite the most aggressive Fed tightening cycle in 40 years, that the labor market is tight and unemployment is at 50-year lows, and he doesn't personally expect a recession. So what's going on?
Well, what happened is you did have back-to-back quarters of negative GDP prints, and it's really just Wall Street colloquial back of the envelope rule of thumb that you get back-to-back quarters of negative GDP, you're in a recession.
Right.
That's because that naturally is what happens in a recession, but not all the time. You didn't have back-to-back declines in GDP, for example, in 2001, and that was a recession. The missing link was that employment didn't go down.
Mm-hmm.
And a recession, technically speaking, from the National Bureau of Economic Research, the NBER, they're the final arbiters of the contours of the business cycle. And it's not really about GDP. It's about really 4 different indicators. real business sales, industrial production, employment, and real personal incomes, excluding government transfers. And so the missing link was employment, which has continued to go up. And so that's why it wasn't a recession, despite what GDP was doing. It would have been a little unusual, seriously, to have expected the recession to start in early 2022 when the stock market was just rolling off its peak. The stock market leads by, call it, roughly a year. So it would have been very unusual to have the stock market lead that quick. And on top of that, there's about a year, at least a year lag between the time the yield curve inverts, which, by the way, was last summer, and the time the recession starts. It would have been, so we would have had a recession starting ahead of the yield curve inverting. I don't think that's ever happened before.
If you follow the traditional time, the lag, then this summer is when we should start to see the economy go negative. Is that right?
I think it could be starting right now. I mean, we'll have to wait and see. Of course, we'll get the employment numbers, but these employment numbers, of course, will end up getting revised in the future. And employment's always the last man standing. It's not even unusual to have employment still go up in the opening months of the recession. Well, I'd say half the business cycles going back to 1950, employment was still going up in the early stages of the recession. So that's not that unusual. When I'm taking a look at the leading indicators, stock market, and I'm looking at market signals. Markets are always ahead of the economy in both directions. Stock market, especially looking at the ratio of cyclical stocks to defensive stocks, looking at the yield curve, looking, for example, at the real bellwether. And sometimes I feel like I'm going to talk myself out of a job or talk economists out of a job, because the Conference Board has the leading economic indicator, which goes all the way back to 1959, an impeccable track record. By the way, the yield curve is one of the factors in there. It's got market indicators. It's got macroeconomic indicators. It is a true leading indicator. Why people are getting head faked is the lagging indicators are still going up, and that's what the Fed's looking at. The coincident indicators are going up, but have actually started to level off. But the leading indicators, if you're driving the bus looking through the front window, the leading indicators peaked in December 2021. They're down 12 months in a row. It leads both whether you're looking at the median or the mean, and the data is back to 1959. So we have at least 7 cycles to look at.
Your headline to clients has been for months now, the business cycle has not been repealed.
It's not, well, and these are centrifugal forces over time, these sine waves that intersect with each other. The market cycle, the interest rate cycle, the economic cycle, they're all intertwined and they're all joined at the hip. So no, it's not different. Maybe the best economist of all time was a physicist, otherwise known as Albert Einstein, who famously said that the power of compound interest is the 8th wonder of the world. Interest rates matter. And we just came off the biggest interest rate shock in a 12-month span, 500 basis points since 1981. We know 1981 was followed by 1982. And we're a much more leveraged economy now than we were back then. If you looked at hours worked, the hours work data, which nobody looks at, I just do it because it's fun. You looked at the hours work data, you think, we're in a recession. And then you say, oh, well, but the actual employment hasn't followed suit yet. But you see, what leads what? What's the chicken or the egg here? Well, the hours worked are telling you that the corporate sector right now, they're like the little boy with the finger in the dike. They are not letting their people go. To quote Moses to Pharaoh, not letting my people go, but they will be compelled to do that. And that's what the hours worked are telling you, is that we're at a turning point in the labor market in the next couple of months. But once you start to see the whites of the eyes of actual employment contracting, that's when this debate over soft landing or hard landing being a recession, that's when there will be much more, I think, acknowledgement that a recession has already arrived. And then the Fed will be cutting interest rates as it always does. And look, this isn't actually a purposeful, be a big bad bear, be a big bad bear. No, it's an acknowledgement that, every expansion was followed by recession. Every recession was followed by expansion. Every expansion is followed, they're joined at the hip. It's like bull markets and bear markets, they exist.
How critical are you now of the Fed in the fact that we're 10 interest rate hikes in?
I'm shocked, because it was just 2 years ago, not even, where Rates are at zero, and I would say 100%. They stayed too accommodative too long. But as
Right.
if we haven't seen that from the Fed before, and they create these, boom bust cycles. He's leading the transitory inflation. Then all of a sudden, he's the new Volcker. He's Volcker on steroids. But really, raising rates every single meeting, 500 basis points in a year. You see, it's not just the magnitude of the shock. It was just compressed into such a short time period, and he didn't give people enough time to prepare. You see what I'm saying? This was a 180-degree turn that we've never seen before. We've seen central banks change their mind, but he went from Bambi to Godzilla in a heartbeat. You see, that's what's happening in the banks right now. Everybody was braced for sustained low interest rates.
Right.
Everybody was braced
Lower for
for
longer.
inflation, and we all knew inflation was going up, and he was telling us it's going to go up and come down. And guess what? Inflation is coming down, and inflation is not like a hot knife through butter. It's a process. But inflation peaked at 9% last June. It's down to 5%. Meanwhile, wide swaths of the commodity markets are either in correction phase or they are in a bear market. Look what freight rates and transportation costs are doing. So the bottom line here is that the shock, you see, everybody was taking him at his word. We had no time to prepare. All these banks that they say, well, they're mismatched in their deposits and their liabilities. They had no time to prepare.
No time to adjust.
Like, what are you going to adjust to right now? Yeah, like the thing is that when you go back and if you take the Fed at their word, okay, you take the Fed at their word, and this comes down to credibility, because how can you believe anything that they say? But here's what I'll say is that we have not seen all those lags yet. I'm trying to say, to go back to, they raised rates from 1 to 5.25, 04 to 06. They pause in the spring and summer of 06 under Bernanke. And then everybody says, oh, sigh of relief, they've paused. Think of all the stuff that happened the next 2 years because of all the lags.
Right.
And what's happening
07,
now,
08.
well, I think what's happening now is a lot like the late 1980s savings and loan crisis. But when you think about it, all these regional banks that are under so much pressure right now, it's sort of like that's just chapter 1.
Are you saying that we are kind of in a similar, that because of the Fed rate hikes that have been so aggressive and so steep and so quick, that we have created a situation where we're going to have these rolling crises that could be the kind of the equivalent of 07, 08, at least in the regional banking sector? Or
Yes, that's
okay.
exactly
Okay.
what I'm saying.
All right.
The reality is that everything is being reset to a much higher interest rate environment.
Yes.
And so these regional banks got caught offside. We're learning in this cycle now. We're always learning something new in every cycle, that all of a sudden deposits are not sticky forms of capital for smaller financial institutions, which, by the way, the country needs.
Right. We need the smaller financial institutions.
Well, because they serve, who
Small
do they serve?
businesses do. Sure.
They
right.
serve small businesses that otherwise couldn't go get loans from Jamie
Yeah.
Dimon and Brian Moynihan. So yes, they are the bedrock. The community banks are the bedrock. Absolutely. And so basically, is the Fed, they're supervising these banks. We find out all these unrealized losses. Oh, it's all the banks, bad management. They were mismatched between the deposits and their assets. Well, they always are. We had a massive interest rate shock, and so this is the net result. The Fed did not actually give you a whole lot of time to prepare.
Despite what Jamie Dimon says, or despite what Jay Powell is saying, the banking system is not strong and resilient. How concerned are you about the banking system, and how concerned should we be, and what do we do as investors?
You can't have a bank like First Republic go under and then days later tell everybody that the system is solid and sound, because you sound ridiculous when you say that. Okay, here's what it says to investors. It makes them nervous. You know why it makes them nervous? Because if you're not concerned, you damn well should be. Now, okay, is Bank America and Wells Fargo and JP Morgan and Morgan Stanley, well, yeah, they're sound and they're solid, sure. Is that the story here? Is that the story, or is the story that we just lost in short order three regional banks?
Right.
Which
Big-
and there's
big
the
regional
small
banks.
banks aren't small anymore.
Mm-hmm.
and they've seen what's happened with the equity prices of a lot of these other. Okay, there's not a deposit run, but the stock market's behaving as though they're concerned that there will be deposit runs at these other banks. We have a crisis of confidence in a critical part of the financial system, and the chief central banker. Well, let me ask you the question: did he express a whole lot of concern
No.
at the press? No, and that's what I mean. So I think that we are going to, at a minimum, and I'm not talking. This isn't 0809. We're not fighting the last war. In 08 and 09, we weren't fighting a dot-com technology deflation crisis, and in the dot-coms, we weren't fighting the savings and loan collapse.
No, we're fighting deposit runs. That's what we're fighting, is bank runs, right?
And a general loss of confidence. And if
Right.
you lose your deposits at a bank, even if you're a well-run bank, you're out of business.
Mm-hmm.
Now, there's other things that can be done. I don't know why the government. No, I think they would need Congress for just announce blanket deposit insurance, blanket unlimited deposit insurance. But no, what did they do? What did they do? They say, okay, we are going to insure your deposits so long as your financial institution is poses systemic risk.
Right.
Then then all of a sudden you want to go and put your deposits in those banks that are systemic risk, and those are the big banks, because Goldman Sachs and Morgan Stanley, and that would be systemic risk. So, but it's creating a tremendous amount of instability.
Mm-hmm.
You're going to have, I think, at a minimum coming out of this, because there's lots of uncertainty. The one thing that Jay Powell didn't say so much at this meeting, but he said back on March 22nd extensively, he actually seemed more concerned back then, and that was after Silicon Valley, that we don't know the extent of the magnitude or the duration of this credit shock, but he was sure that we're going to be having a credit shock, which is actually a deflationary event and has pernicious downward impacts on aggregate demand growth. I think at a minimum, we're going to be going through a credit contraction. The savings and loan crisis, well, that was a 3-quarter recession, wasn't the end of the world. Classic bear market in stocks, but we had a very muted recovery. Remember, going into 1992-93, already 2 to 3 years after the recession technically ended, Alan Greenspan was still talking about 60-mile-an-hour headwinds. So that's what this looks like to me, and that was a prolonged period of consolidation in a key part of the bank system. And we're going to be seeing more of that now. We're going to be seeing consolidation. The banks are naturally going to be a lot more cautious about extending credit to the private sector. I think that the most creditworthy borrowers are going to be fine.
So what is my new reality as an investor? How is this going to affect the markets, the stock market and the bond market, and how do I invest through this period?
Well, he'll be changing his mind. Okay. I mean, I'm not a psychologist, but I know how to study behavior. Economics actually is the study of behavior. It's a social sciences. Well, look, in 2018, he's Darth Vader. 2019, did anybody say he's going to cut rates 3 times and reopen the balance sheet? No. Then 2020, 2021, he's targeting minority and female and youth unemployment rates. He's he became, after the pandemic, he was the country's resident social worker. Then all of a sudden, from Bambi to Godzilla. So what I'm saying is that he'll be singing a different tune in the second half of the year into 2024. So I think that if you're an equity investor, be in the defensive sectors, the sectors that won't hurt you in a recession. That could be consumer staples, it could be healthcare, it could be utilities. Be very mindful of what's called the beta or the degree of risk and cyclicality that you have in the portfolio. But I'd say
so anything that is sensitive to
GDP
the economy,
sensitive, yeah,
right? Just
don't
right.
own, don't own.
And I know long Treasury bonds. You thought, because you think that the Fed's going to cut rates, that long-term interest rates will come down, right? As well, because the economy is going to slow. So are you still advising owning long-term Treasury bonds as well?
I do. I think that what's going to happen, the Fed's going to pause. I saw this person being interviewed today, and she says, well, it's a pause, but not a pivot. Well, unless there's a true financial calamity like, October 1987, or long-term capital or a pandemic, the Fed is a very slow-moving incremental institution. So to say, well, it's a pause, not a pivot, of course. They usually wait 6 months before they start cutting rates, and the bond market's ahead of it. Look at bond yields have been coming down for the past 6 months.
Right.
The yield curve is ultimately going to go back to what it normally does 85% of the time. It will go and revert to a more positive shape that'll require the Fed to cut interest rates. So the whole yield curve is going to come down.
Okay.
So I like the long bond because of the fact that the ECB and maybe the BOJ and the Bank of England will still be playing some catch up, even as the Fed is on hold. These central banks will be raising interest rates. It's going to create more of an allure for their currencies. So I think the US dollar, which has already been sputtering, is going to sputter further. And all you have to know about gold is this: the two most powerful correlations, real interest rates, which are going to be coming down, and the US dollar, which will continue to come down. I think gold goes to new highs. We're actually very close to that as we speak. So it's and it's because I also love alliteration. So the bond bullion barbell is my preferred strategy right now.
Right. So on one end, have long treasury bonds, on the other end, invest in some gold. And you personally are doing what with your portfolio at this point?
Well, I have the lowest share, the lowest proportion of my asset mix in equities since guess when, 2007. Yeah, I'm less than 20% in equities, but again in defensive areas. I have call it roughly 30% in bonds, 30% in cash, 5% in gold. And my last move in gold was actually buying gold coins and storing them at the Canadian Royal Mint, and because I like the portability. And the rest is in alternatives, and mostly market neutral long short strategies that again are not correlated with the economy or with the stock market.
Dave, one investment for a long-term diversified portfolio. What should we all own some of in a long-term diversified portfolio?
One of our longer term themes, well, there's a couple of things. I would say farmland, agriculture, very important because of security of supply. So I think agriculture.
But how do you buy that stuff?
There's ETFs, and you can actually go out if you're willing to sacrifice liquidity and go out and buy farmland.
Right. Well, that's not a practical option for most of us.
No, but somebody that we both know well, Peter Bookvar, actually told me the money that he's been investing in the Midwest in farmland. So I mentioned it in my daily, and it was like I was inundated with, can you introduce me to Peter? I would say, look, aerospace defense, cybersecurity, the green technologies. These are all long-term thematics. Energy, I'd say both old energy, new energy. I think that you want to be involved in undercapitalized, underinvested sectors. So I like energy. I like food. I like the things that you actually need in your life, not the things that you want. So.
Right.
There's parts of consumer discretionary, gadgets and clothing and restaurants. So the reopening trade has pretty well run its course. But those are the areas: aerospace defense, because military budgets are going up everywhere. Agriculture and energy, and those are the buckets I think you want to have long-term thematic that resides outside the vagaries of the business cycle. And look, this time next year when we'll be talking about Fed cutting, positively sloped yield curve, and economic recovery. And I will be bullish.
Yes, you will, Dave Rosenberg, when that day comes. You've been there before.
Nobody ever believes me when I do, but you heard it here first. Perma-bear to perma-bull 12 months from now. That's my call. I'm sticking to it.
Thank you so much, Dave. Always a pleasure to have you on Wealth Track. Thank you very much.
Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point follows up on advice Dave Rosenberg has given us every time caution signals are flashing in the economy and markets, and they are definitely flashing now. It is own some safe haven investments in your portfolio. Cash for protection and to redeploy when stock prices decline. Long-term treasuries, they're the world's safe haven investment of choice because of their liquidity and still valid assumption that their interest payments will be made and principal paid upon maturity. Bond yields always decline in recessions. That means bond prices go up. Depending upon your time horizon, 10-year or 30-year maturities will benefit the most as rates decline. And of course, there is gold. For those of you really concerned about the uncertainty in the world today, that is the go-to asset. Rosenberg owns gold coins in his portfolio. A much easier option is one of the older and established gold ETFs, like the Spider Gold Shares ETF, symbol GLD, or the iShares Gold Trust ETF, symbol IAU. Price matters, and gold is trading near historic highs, so this is not an optimum time to load up. But having some safe havens at a time of heightened financial and geopolitical uncertainty is a prudent move. Next week, we will tackle long-lasting market-shaping investment themes with Savita Subramanian. It's part 2 of our interview with this top-rated strategist at BofA Global Research. In this week's extra feature, the pressures brought to bear on bears. Dave Rosenberg shares his firsthand experience on why Wall Street doesn't like negative market views. Please continue to follow us on Facebook, Twitter, and our YouTube channel. Thanks for tuning in. Enjoy your weekend and make the week ahead a healthy, profitable, and productive one.